Good morning. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is entitled Securitization, What to Expect in 2021. My name is Tameem Zainulbhai, and I'm a partner in Mayor Brown's Chicago office and a member of the banking and financing practice. I concentrate my practice on a range of matters related to residential, commercial, and consumer loans. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to gfm@mayorbrown.com. That's Gary Frank Mike at mayorbrown.com, and we will respond promptly. This is the same email address on your invitation email. Joining me today are partners Paul Forrester, Cory Miggins, Russell Nance, Keith Oberkfell, Andrew Olmem, and Jeffrey Taft. Paul is a partner in our Chicago office and a member of our corporate and securities practice with a focus on structured credit, including CLOs, energy, financing, and project development. Cory is a partner in our Chicago office and a member of our banking and finance practice with a focus on domestic and cross-border securitization and other structured finance transactions. Russell is a partner in our New York office and a member of our tax transactions and consulting practice, covering, among other things, tax-related matters in structured finance transactions. Keith is a partner based in our Charlotte office and a member of our banking and finance practice, focusing on securitization and other structured finance products, including CLOs and BDC facilities. Jeff is a partner in our Washington, D.C. office and a member of our financial services regulatory and enforcement practice. His focus includes bank regulation, bank receivership, and consumer financial services. Andrew is a partner in our Washington, D.C. office and a member of the public policy, regulatory, and political law practice. Prior to joining Mayor Brown, he served as the Deputy Assistant to the President for Economic Policy and Deputy Director of the U.S. National Economic Council, where he oversaw the development and coordination of all domestic economic policies, including for financial services. With those brief introductions, we will now begin today's discussion, beginning with Andrew Olmem. Andrew, I pass it over to you.
Thank you. I'm going to give an overview of what we can expect in terms of the direction of financial services policy during the Biden administration and how that agenda will likely be implemented. During the presidential campaign, the Biden administration set forth a clear financial services policy agenda focused on passing another stimulus bill, incorporating climate risks into financial services regulation, strengthening systemic risk regulation, and strengthening consumer protections, including through stronger enforcement and a new focus on fair lending and equity issues. Now, my colleagues today will provide more details on several of these policies, but what's important to understand is that implementation of this agenda is going to be significantly impacted by the nature of the Democratic majorities in Congress. While the 2020 elections have left the Democrats in control of both the presidency and the U.S. Congress, the Democrats have only razor-thin majorities in both the House and the Senate. Indeed, in the Senate, split 50-50, Democrats are only in control due to the tie-breaking vote of Vice President Harris. Plus, there's some sharp differences between Democrats on financial services issues, which adds to their difficulties in likely securing votes for financial services bills. This fragile Democratic control of Congress has three clear implications. First is that the Biden administration will have only a limited ability to pass legislation. With such narrow Democratic majorities, the Biden administration will need to work with Republicans and Democrats in swing districts to pass legislation. Accordingly, major financial regulatory reforms are probably off the table for the time being. However, the Biden administration should be able to secure passage of both another stimulus bill as well as an infrastructure bill. Any stimulus bill will likely include more support for unemployed workers, which will help Americans continue to pay their financial obligations and thereby minimize the spillover effects of the economic downturn related to COVID into financial markets. It's also likely to include additional protections for homeowners and renters in the form of extended and expanded payment forbearance and eviction moratoriums. With respect to an infrastructure bill, it's likely to provide considerable funding for traditional infrastructure projects, but also significant subsidies for green energy research and development, electric car infrastructure, home efficiency programs, including solar energy. Many of these provisions have strong bipartisan support in Congress. I will note that the Biden administration would also be able to pass tax legislation using a procedure known as reconciliation. However, it's unclear whether the administration will seek to move such legislation now or in the future, but it has signaled that it is looking at increasing corporate tax rates and taxes on high-income individuals. Given the size of the federal deficit and the cost of the Biden agenda overall, it's hard to see how the administration does not seek additional tax revenues either now or in the near future. Second, the narrow majorities in Congress will prompt the Biden administration to implement most of its financial regulatory agenda through the financial regulators. Since the Senate is in Democratic hands, the Biden administration should have most of its financial regulatory nominees confirmed fairly quickly. U.S. financial regulators possess broad authorities, so once Biden's nominees are confirmed, they should be able to move reasonably quickly to begin implementing the Biden agenda. As my colleagues will discuss further, along these lines, the Biden financial regulators are likely to take action to, among other things, adopt new regulations on climate disclosure and incorporate climate risk into bank risk management frameworks, reinvigorate the Financial Stability Oversight Council to have it consider applying enhanced prudential regulations to certain non-bank financial companies, including possibly asset managers, investment companies, and/or non-bank mortgage companies. Also adopting new consumer protections and reversal of certain Trump-era financial services policies, including potentially, the Volcker Rule, the OCC's True Lender Rule, and potentially the Qualified Mortgage Rules. And finally, there are likely to be more support from federal regulators for state consumer protection agencies and their enforcement and regulatory efforts, which are consistent with the Biden administration's agenda. Third, and finally, the final consequence of the Democratic makeup of Congress is that the progressive wing of the Democratic Party will be able to exert a significant influence on financial services policy. Both the House Financial Services Committee and the Senate Banking Committee, which oversees the confirmation of financial regulatory nominations, will be chaired by Representative Maxine Waters and Senator Sherrod Brown, respectively. Both are prominent progressives. This likely means that nominees to financial regulators will be more likely to be from the progressive wing of the Democratic Party, which you've already seen with Biden's nominees for the heads of the Consumer Financial Protection Bureau and the Securities and Exchange Commission. It also means that that congressional investigations of the financial services industry are more likely. Indeed, Chairman Brown has already indicated that he intends to have hearings with bank CEOs. It also means that Congress could use the Congressional Review Act, which allows Congress to use expedited procedures to invalidate recently adopted regulations. The Congressional Review Act could be used potentially for any regulations promulgated after August 21st, 2020. This could include, for example, the OCC's True Lender Rule. Progressives have been very clear that they would like to use the Congressional Review Act as aggressively as possible to invalidate Trump-era regulations. Now, with that overview of the overall political environment and approach to financial regulation over the next couple of years, I'll now turn it over to Jeff Taft to discuss in more detail some particular regulatory actions.
Thank you, Andrew. I'm going to spend a few minutes today talking about Madden and True Lender developments and then provide a high-level or very high-level identification of some key points to watch in 2021 in consumer financial services. On the Madden True Lender front, 2020 was a good year from the industry's perspective, as many of the Madden and True Lender developments were favorable ones, including the OCC and the FDIC's rulemakings and some favorable litigation outcomes. The Madden and True Lender litigation results include a favorable settlement in the long-running Colorado litigation between WebBank, Cross River Bank, Marlette, and Avant. The settlement provided some clarity with respect to previously made loans and created a safe harbor for future originations. Given the decisions related to several key motions in the litigation, the settlement provided the secondary market with some degree of certainty. we're starting to see people again buying Colorado loans that meet the safe harbor requirements in the assurance of discontinuance in Colorado. Also on the litigation front, Capital One and JP Morgan Chase's credit card platforms were able to defeat lawsuits in 2 federal courts in New York. These lawsuits were challenging the ability of the Securitization Trust to collect interest at the rates permitted by the cardholder agreement. The plaintiffs there had raised a Madden-like claim against the Securitization Trust, challenging their ability to collect interest at the rate that the bank was charging before the receivables were transferred to the credit card Securitization Trust. That was a helpful win for the banks to get those lawsuits knocked out on a motion for summary judgment or a motion to dismiss in September. And the appeals in those cases by the plaintiffs have both been dropped now, so that's been a favorable development. On the regulatory front, as I said, in 2020, the FDIC and the OCC issued valid when made rules to address the concerns and uncertainty presented by the Madden decision. These rules provide that usury is effectively determined at the origination of the loan, and a subsequent transfer of the loan by the bank to a non-bank does not subsequently make that loan usurious in the hands of the secondary market purchaser. Obviously, this is very important for the secondary market and for the industry in general, and those rules were welcome. The news was not all good, though, because those rules are now currently being challenged by a group of state attorney generals, both on procedural and on substantive grounds. This litigation was generally expected by both the industry and the OCC and the FDIC when the rules were promulgated. So it's really just a question of it playing out through the natural course of the evolution of the litigation cycle. I think in 2021, the OCC and the FDIC are going to be forced to defend these rules through the litigation process, and the outcome is going to be of great interest to the secondary market participants. The OCC litigation is further along than the FDIC litigation. They've already filed a motion to dismiss earlier this month, and the banking trade groups filed an amicus brief in support of the OCC. I think it was last Thursday. So that litigation is moving forward, and the FDIC litigation will follow soon after that. On the true lender front, the OCC issued a final rule in October providing that a bank is the true lender if it's named on the loan or if it funds the loan. This is really important for bank partner programs and for people who are buying loans in the secondary market, obviously for bank partner programs, and want that that added certainty around whether the bank in fact was the true lender. The secondary market and others have been seeking this clarity for years. Again, the bank news, the good news is that the rule has been promulgated. The bad news is also this rule is being challenged by the state AGs as well. A lawsuit was filed in early January of this year. Aside from the pending litigation, there also remains some concern around this final rule that it could be overturned under the Congressional Review Act, as Andrew mentioned. Also, it's also not clear at this point whether the new comptroller of the currency will be supportive of this rule and whether they will zealously defend the rule. So that's something else to keep in mind. The validity of this rule will be an important point for the industry to monitor in 2021. If the courts uphold the OCC and the FDIC valid when made rules, and the true lender rule is also upheld, it will bring clarity and really finality to the industry and bolster the secondary market for loan purchases, especially those from bank partner programs. So let me just quickly touch upon a couple of consumer and small business developments that are also going to be likely going on in 2021. First, and Andrew alluded to this, obviously, there's going to be increased federal and state enforcement actions, and a number of new rulemakings are going to be focused on consumer protection. The new agency heads at the CFPB and the banking agencies will certainly drive a more consumer-focused agenda. Second, some of the key areas that we think they'll be focusing on will include fair lending, debt collection, and servicing. Those are certainly areas that are going to be ripe for enforcement and for rulemaking. The increased focus on debt collection and servicing will arise both at the state and federal level. Well, some of this is really driven by COVID-19 and the higher unemployment that we've seen in the last 6 or 9 months. It also reflects an increased focus on consumer protection in general at the state and federal level. Finally, I want to talk a bit about small business lending, which I think will also be on the state radars. This could mean more licensing or disclosure requirements for small business lenders at the state level. As you probably know, California enacted legislation in 2018 that required disclosures for commercial financing transactions. And that's not just loans. That includes merchant cash advances, factoring, and other things. And at the end of last year, New York adopted a similar provision as well. Neither one of these are effective yet. There's rulemaking that's going on right now in California and will be going on in New York in order to get them to a point where they can actually be implemented. But that's something to keep in mind. States are copycats, and once one or two states do it, you see other states oftentimes jumping in. So with that whirlwind, let me turn it over to Paul Forrester, who's going to talk a little bit about LIBOR.
Thanks, Jeff. And as you would all expect, LIBOR is going to be a significant event in 2021. December 31, 2021 was the original deadline. It remains the deadline for all currencies and tenors of U.S. dollar LIBOR other than 3 and 6 month LIBOR. So there's a lot going on. In fact, just recently, the ISDA protocol and amended definitions to allow for LIBOR transition have become effective. The IBA, the ICE Benchmark Administration that's responsible for publishing LIBOR has a current consultation, which closes today, actually, January 25th. And accordingly, we expect shortly thereafter, the formal notice of IBA is to the cessation of all currency IBORs and U.S. dollar LIBOR, with the exception of 3 and 6 months, which will be June 30, 2023, as expected. That notice will potentially trigger the first of a number of actions that are required under amendment and fallback provisions in documentation. And certainly, again, we expect this to be a very significant year for all financial intermediaries to be corresponding with their counterparties and customers over related developments. I would note that it's going to be a significant paper exercise, as was known from the beginning. Some 90% of the leveraged loan market is still under amendment fallback provisions. They have to be amended. The legacy contract problem remains a problem, although we've had recent good news. New York State included LIBOR transition assistance legislation in the governor's budget proposal. So New York State's legislature will be hopefully taking that up shortly. And we understand that federal legislation is in the process of being introduced. The current sponsor is seeking co-sponsors for that legislation. So there's some prospect to be hopeful that we'll have U.S. legislative solutions to address the tough legacy contracts. Equally, outside the U.S., the benchmark regulation is being amended to allow for transition for tough legacy contracts, and the United Kingdom, which is obviously no longer part of the EU as of January 1st, is pursuing legislation that would allow the Financial Conduct Authority to promulgate a synthetic LIBOR. They have a current consultation which is seeking some direction as to how they might exercise those anticipated regulatory powers. So it's going to be a very active year for LIBOR, and certainly it's going to be all hands on deck if we're to accomplish it without major disruption. So with that very brief overview, I'm now going to turn the call back to Russell Nance to talk about tax.
Thank you, Paul, and I will keep this largely brief. And that's a good transition because the first of two things that I want to discuss are LIBOR transition and how that relates to the tax world and the consequences of transitioning to something other, a benchmark rate other than LIBOR. The stakes here, the consequences from the side of converting from a LIBOR-based rate to a non-LIBOR-based rate all circle around for debt instruments, whether the debt instrument has been significantly modified, which is a technical term, and results in a deemed exchange. And that can have a number of consequences, including gain or loss to the holder and income and deduction consequences to the obligor, and it can also have collateral consequences. For example, in a REMIC, if you have a loan that has been modified in this way, there are certain concerns that it could no longer be a qualified mortgage and other things in grantor trusts. So we're expecting to see movement in this particular area in 2021. In 2019, IRS and Treasury came out with the 1001-6 regulations, which provided some outs in this particular area for LIBOR transition. Late in the year, there was an additional authority provided by the IRS that allowed some additional transitions based on the ARC recommended language, but those provisions, the transition had to be very closely tailored to what ARC provides, and there are still some questions as to whether there will be additional guidance from the IRS on this point. So we will be keeping an eye out for that. I personally am not expecting the change in administration to have any effect on this because the individuals at IRS and the Treasury who have been working on this particular issue will continue to be working on it. And it does not appear, from my perspective, that their views will change on this based on the administration. But I would not be surprised if we saw an additional safe harbor that comes out through the IRS. On the pandemic side, there are two main areas that I want to talk about briefly just for people to keep an eye out. One is that the IRS in the spring of 2020 came out with Revenue Procedure 2020-26, which deals with loan forbearance and loan modifications for certain entities like REMICs and grantor trusts, and applied to forbearances and modifications that happen pursuant to the CARES Act and similar sort of programs by the end of the year, by the end of 2020. That has been extended to the end of September 2021. So if a loan is entered into forbearance or if it is modified and deferred pursuant to one of these programs before the end of September this year, then the same guidance in Revenue Procedure 2020-26 would apply, which generally allows these loans to go into forbearance and to be modified without adversely affecting REMIC characterization, grantor trust characterization. So I expect to see some more a practice arise about how these particular provisions are to be applied in individual contexts. And lastly, I expect in 2021 we will see greater investment in distressed debt like we did during the financial crisis. There are still some tax issues that relating to distressed debt investing that were not completely dealt with during the financial crisis and have still been out there in one way or another. For example, how does market discount apply to a distressed loan that's acquired at a significant discount that relates to credit issues and not the prevailing market rates? There's no definitive answer to that. So we will see as this investing likely picks up throughout 2021, distressed debt investing, whether we see any guidance on these particular issues like that, or like whether investing in debt and working it out is a U.S. trade or business. Those sorts of things, we may see additional guidance on that as there is additional pressure from increased distressed debt investing. But we shall see. And I will turn it over now to Keith Oberkfell.
Thanks. This is Keith Oberkfell, and I just wanted to give a couple brief updates on what we're seeing in the CLO market. It's basically three major trends. The first trend is fairly easy. It's the transition period where the UK had piggybacked off of the EU, came to an end at the end of 2020, and now the legends and risk factors separating the different regimes have to be updated in the documents. This should be a fairly easy and routine update, but you'll see changes in the documents. The second a trend that we're seeing is CLOs responding to the amendments from the Volcker Rule, which went into play in early of October 2020. We see two different things. Certain deals are adding bond buckets, 5% bond buckets where investors are amenable to it, and also relying on the loans and continuing to rely on the loan securitization exclusion. So you can have all loans plus 5% bonds in your transactions. But also with the recent Volcker amendments, there's more clarity on what constitutes an ownership interest, and that the removal of the collateral manager for cause where it's not an event of default does not constitute an ownership interest. And in that sense, we're seeing more CLOs decide not to rely on the loan securitization exclusion. They can just rely on 3C7 of the Volcker Rule of the Investment Company Act, and still have banks buy senior notes and not worry about having an ownership interest in a covered fund. And the third trend that we're seeing is all the CLOs trying to build in workout flexibilities to the documents. over the past year and a half, a number of CLO managers have been restricted on their ability to participate in some of the various forms the workouts have undertaken with troubled credits. And so now, to the extent investors are amenable, the CLO managers are trying to have more flexibility in using interest proceeds to buy collateral obligations that don't necessarily meet all the criteria of the obligations that you would have at closing, but still get credit in the over-collateralization ratios, and also more flexibility to use interest and principal proceeds both to buy obligations which don't meet any of the collateral criteria and don't get credit for the OC ratios, and also to different changes in the waterfall or investor contribution mechanics to allow additional funds to be available should workout opportunities arise where investors may be incentivized to try to preserve value where credit is otherwise in peril. And so those are the major trends that we're seeing. But in all those cases, given how thinly traded CLOs are, where one anchor investor has a significant amount of influence, we see different levels of adoption and responses to those changes. In some transaction, investors want the same transaction that they had invested in 6 months ago or a year ago. And other transactions, we're seeing significant changes that are trying to be as up-to-date as possible with as much flexibility as possible. And so that's what we're seeing in the CLO market, and I'll hand it over to Cory Miggins.
Thanks. This is Cory Miggins. I wanted to cover a few disclosure and diligence-related topics that have come up recently in asset-backed securitization transactions. The first topic I wanted to cover relates to how COVID-19 is being addressed in new ABS transactions. Lately, we've been seeing fewer comprehensive COVID-19 due diligence calls like we were seeing at the beginning of the pandemic. Instead, there's often been a bring down type question in the pre-pricing due diligence call questions, asking about any changes since the prior COVID-19 due diligence call or changes since the date of the disclosure in the disclosure document. Issuers and underwriters have been more focused on updating the disclosure document regarding the impacts of COVID-19 on the servicer of the transaction and on the portfolio, including disclosure about any hardship programs currently in effect and whether there have been any changes in the servicing and collection policies as a result of COVID-19. Recent ABS disclosure documents have also included the number and dollar amount of COVID-19 related delinquent loans. One item that came up at the beginning of the pandemic and continues to be an issue in ABS transactions is how the transaction defines delinquent loans and defaulted loans in the transaction documents, and how COVID-19 related deferrals or forbearances fit within those definitions. That is to say, do those definitions of delinquent loans and defaulted loans refer to the loan being past due, or does it refer to a loan having payments that haven't been made on a scheduled due date? You can see that in one instance, a COVID-modified loan may not be treated as a delinquent or defaulted loan, and in another instance, they may be. As a result, it's important that these definitions be clear and unambiguous on this point. The next topic I wanted to address relates to changes in the SEC's rules regarding risk factor disclosure for most publicly registered deals. This rule came out in August of 2020 and went effective in November of 2020, and we've been seeing this rule being implemented in deals that have come to market over the last few months. The goal of this rule is to shorten the risk factor disclosure and make it more concise and targeted to the particular risks of a given company, rather than listing and focusing on general risk factors that could apply to any company in the market. Under the new rules, the risk factors are required to be organized logically and grouped under different subheadings. If there's a risk factor included in the disclosure that's more general in nature and could apply to other companies, the SEC suggests putting those risk factors in a separate general risk factors section at the end of the risk factor disclosure, though the issuer should still include a concise explanation of how those general risk factors apply to their particular company. The rules require that if the risk factor disclosure is more than 15 pages in length, there needs to be a bullet point or numbered summary, not more than 2 pages in length, of the principal risk factors. Some issuers may decide to do a summary even though they're below that 15-page limit, just in case they need to add a risk factor in a future deal so they don't have to scramble at the last minute. This rule requires that the summary be located in the forepart of the prospectus. So there's been some differences in the market in how that term, the forepart of the prospectus, has been interpreted. Some issues have placed the summary immediately after the cover page, others before the summary of the offering document but after the table of contents, and others after the summary but before the risk factors themselves, just so long as the summary appears in the forepart of the prospectus. The next topic I wanted to address relates to electronic signatures on documents to be filed on the SEC's website. Recently, in November of 2020, the SEC amended its rules to permit the use of electronic signatures on documents to be filed on its on the SEC's website. Before using electronic signatures, a signatory is required to manually sign an electronic signature authentication document. There are also requirements that the electronic signature itself must meet, including a timestamp to record the date and time of the signature. These documents, both the authentication document and the electronic signature itself, are required to be retained by the company. The authentication document must be retained for 7 years or as long as the individual is authorized to sign, whichever is longer, and the electronic signature itself must be retained for 5 years. The authentication document is required to be furnished to the SEC upon request by the SEC. And last, I quickly wanted to touch on how LIBOR replacement has been being implemented in recent ABS transactions. Lately, we've not been seeing a ton of floating rate deals. Those deals that have issued a floating rate A2 class have tended to use the last LIBOR replacement language that was used by that issuer rather than incorporating a new fallback mechanic. Conversely, in warehouse transactions, we've been seeing increased adoption of a hardwired LIBOR replacement approach that would generally result in the use of daily simple SOFR as the LIBOR replacement benchmark. Generally, the LIBOR replacement language that we've been seeing in recent transactions is largely aligned with the ARC's recommended language, with some transaction-specific differences around the margins. And now, with that, I'll turn it over to Tameem Zainulbhai to discuss what to expect regarding mortgage-backed securitizations.
Thank you, Cory. With respect to the securitization market for residential mortgage loans, one topic we are focused on is the definition of qualified mortgage. So last October, the CFPB issued its final regulation revising the definition of a qualified mortgage under its ability to repay requirements. Recall that the ability to repay law requires residential mortgage lenders to make a reasonable and good faith determination of a borrower's ability to repay a loan at the time of origination. Ability to repay is important from a securitization perspective because, unlike most consumer credit laws, there's explicit assignee liability. So in other words, a borrower can raise a defense to foreclosure by a subsequent loan holder based on the originating creditor's violation of the ability to repay requirements. The defense can't prevent a foreclosure per se, but can result in money damages that will reduce the total indebtedness and slow down any foreclosure. A loan that is a so-called qualified mortgage is presumed to satisfy the ability to repay requirements. Also, the risk retention requirements for mortgage securitizations do not apply to qualified residential mortgages, which, as presently defined, is the same as a qualified mortgage. Thus, any changes in the definition of a qualified mortgage automatically pass through to the exemption from risk retention. The final regulations made 3 major changes to the existing regulations. First, the regulations eliminated 2 of the alternative underwriting tests for a qualified mortgage. That is, a loan that is eligible for sale to Fannie or Freddie, or a loan that has a debt-to-income ratio of 43% or less, calculated in accordance with the so-called Appendix Q. There remains a requirement for creditor to underwrite a borrower, which it refers to as the consider test, and base its consideration on third-party documentation of income and other assets, which it refers to as the verify test. The regulations, however, do not prescribe the use of any particular underwriting standard, as long as a lender adopts and applies policies and procedures of its underwriting requirements, and the loan file evidences their application. Second, the regulations imposed a price ceiling for a loan to be a qualified mortgage loan. Loans with an average percentage rate, as defined in the Truth in Lending Act, of more than 225 basis points over the so-called average prime offer rate fall outside the qualified mortgage designation. And last, the regulations provide a new type of qualified mortgage based on a borrower's positive payment history over the first 3 years since origination, but this new exception is not available for loans intended to be securitized. The effective date of the final regulations is March 1st. However, President Biden's new executive order freezing or pausing all newly issued regulations not yet in effect appears to apply to this regulation. So it is not clear right now when and if the regulation will go into effect as previously published. Many of our clients have consulted with us as to whether loans that now fall outside of a qualified mortgage designation, a so-called non-QM mortgage loan, now can fit within the QM designation based on the final regulations elimination of the prescribed underwriting requirements. The interplay of these regulations between the QM securitization market and the non-QM securitization market is something we'll be watching closely in the coming months. One other item we'll be watching closely is whether the SEC reforms asset-level disclosure requirements in Reg AB for SEC-registered RMBS offerings. In October of 2019, the SEC asked for public input from investors and other market participants regarding these disclosure requirements and received comments throughout 2021 from the Structured Finance Association, SIFMA, Mortgage Bankers Association, among others. We hope to hear from the SEC on this topic sometime in 2021. That concludes our discussion for today. Thank you to our audience for tuning in. And a few brief reminders. You will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayerbrown.com. That's Gary, Frank, Mike at mayerbrown.com. Thank you again for your participation. You may all now disconnect.